Okay, so welcome everybody. This is Jimmy Young speaking. Today is October 17th at 7 p.m. over in London. And this is the first of 6 live webinars I'm doing. I got hundreds of people when I've been in London have told me, gee, Jim, I'd love to join your programs, and I really think that I want to do this, but I just don't have enough basics. I just feel I'm really lacking in the basics. What should I do? And many of you here right now may even attest to this, what I told you to do. Well, go to babypips.com and learn it from there, learn the basics from there. When you're ready, come see us again and we'll get you signed up. And I decided to go ahead and put together 6 live training sessions because when I was in London in October, I had a few students who signed up anyway, and they were kind of nervous about being able to make the transition so quickly. And I said, you know what, I'm going to go ahead and put six training sessions together and really cover the basics. So what you need to remember about these 6 sessions is that these are all meant for the beginner. These are all meant to be as basic as I can possibly think. My mind will allow me to think as basic as possible. Today we're going to be talking about basic trading and basic Forex. I'm going to share my desktop with you now and get started. And so today we're going to be talking about the basics of trading and the basics of Forex. And next Monday we're going to be talking about charts. And the week after that we're going to be talking about technical indicators. The week after that, fundamentals. The week after that, psychology, trading plan, etc. And the last week, we're going to wrap it all up and try and put it all together. But remember, this is all meant to teach you how to trade Forex, how to trade in general, and how to trade Forex. It does not teach you how to trade Forex profitably. It just teaches you how to trade it. And that's something you want to keep in mind. You know, going to the next level is very important to where you get some systems, some things to work with, some signals, some systems, some methodology. All of that will come later on. Right now, over these next 6 weeks, what I'm attempting to do is to just get a lot of people up to speed on what trading is about and what Forex is about in a very simplistic way. And it was challenging for me even to put together this first session because I don't think on this level. But I got some help from my son. And by the way, my son's already quit my little business. He lasted a month. And I had a little head-to-head with him and said, so how's it going? What are you thinking? How's this working for you? And in the end, we decided that I am going to train him up this week, and he's going to start trading live next week and forget all about this angle of the business and just focus strictly on trading. And it's okay with me, and he seems a lot more excited about that than he did about becoming part of this business. But this morning, for a couple of hours, I went over what you're about to see with him because he's at that very first level. He knows nothing about trading really, or Forex, and so he went through these PowerPoints with me. And he's starting at your level. And believe it or not, within a week's time, I'm going to have him up and trading real money. That's because, you know, I have more time to spend with him one-on-one, and I guess it's in the genes. So I think he can do it. But I'll be keeping you posted on his progress in the Trade Finder and stuff, and letting you know how he's doing and all. It'll be interesting to see. Okay, so let's get started here. Enough about me. Let's talk about you. Let's get started here. So what is Forex trading? Forex trading is a way of making money. You're speculating on an exchange rate moving in a certain direction. You can make money on the exchange rate if it's going up, or you can make money on the exchange rate if it's going down. The strategy is to try to buy low and sell high, or to sell high and buy low. And that second statement is still very confusing for a lot of people. How do you sell something you don't own? And that's why we need to start at this basic level and understand exactly what we're doing when we're trading Forex and how it's entirely possible to sell something we don't own. Here's just a little chart. It doesn't matter what the chart is, but the basic idea of the game is to buy at a low price and sell at a higher price, or to sell first at a higher price and buy it back at a lower price. And because we're only betting, or we're only speculating on the movements of the exchange rate, which we'll get into in 1 minute, we're not physically selling anything, so we don't need to physically have anything to sell. We're just betting on the direction that this chart will go based upon the exchange rates, which we'll get into in just a moment here. So in Forex, we're betting on the direction of the exchange rates. Okay, so when you do what's called a buy transaction, you're betting on the exchange rate going up. And if the exchange rate goes up, you make money. Or you can also make money by betting that the exchange rate will go down. So you're selling. But you may want to think about it as buying and selling, or simply making a bet on the direction. So if you think it's going to go down, you're betting that the direction is going to be down, and in order to be a winner, the direction would have to be down. So it doesn't matter whether you're betting on it going up or betting on it going down. If you get it right, you make money. If you get it wrong, you lose money. So here's the exchange rate, like 163.50. This is an exchange rate. So there's the exchange rate right there. And if you were betting that the exchange rate is going down, you would be betting that the chart would be going down. If you're betting on the exchange rate going up, you're betting on the exchange rate going up. So here it's going up, and here it's going up. This whole period it's going down, and that's all we're doing. We're just betting on whether this is the exchange rate. If this arrow moves up, the number gets bigger. That means the exchange rate's going up. If this arrow was to move further down the chart, this number will be getting smaller, and that means the exchange rate is going down. Where you put the trade on and then where you get out determines your results. So if you bought it here and you sold it anywhere, and anywhere up to here, all of these places would be a profit because it's above where you bought it. If you bought it and you sold it anywhere down here, it would be a loss. So what is an exchange rate? We probably want to know what this thing is. A simple definition of an exchange rate is simply one country's money. You in the UK, you're talking about the pound. Over here, we're talking about the US dollar. In Europe, you're talking about the euro. In Australia, you're talking about the Aussie. In Switzerland, you're talking about the Swiss franc. One country's money valued or quantified in terms of another country's money. So a pound equals, let's say, 1.6350. That's what you'd see when we get to the point where we're looking at a spread betting platform, which is where you go to place your bets. We're going to get into that soon. But 1 pound, what it means is 1 pound equals a certain quantity of US dollars. And 1 pound equals 1.6350 US dollars. So another way of saying that, 1 pound is worth $1.63 and another half a penny. This is all an exchange rate is. You're just looking at two currencies. The first currency in the pair is what's being valued, and the second currency in this two-currency pair is what it's being valued in. So the pound is being valued in dollars. If you bet on the exchange rate of the pound-dollar currency pair has an exchange rate of 163.50, if you're betting on that going up, you're saying that this number is going to get bigger. If you're betting on it going down, you're betting on this number getting smaller. What you need to be very clear on is you are not buying pounds or selling pounds or buying dollars or selling dollars. You're simply making a wager, a bet on which way this exchange rate is going to go. That's all you're doing. So if you bet on it going down, if it goes down, you win. There's nothing about ownership involved here, and therefore there's nothing to worry about in terms of selling something you don't own, because you're not selling anything, you're just betting on the direction of that exchange rate, whether it goes up or down. And we use the term selling, but you're really not selling anything. You're just betting on the direction down. So the sell equals betting on down, and buy equals betting on up. Now, what makes the exchange rates move up and down? Basically, I tried to keep it as simple as possible for you and identify the three major sources of movement. And what they are is prior up moves and down moves cause current up moves and down moves. New news in itself means something new, hence the word NEWS. Really what that word means is something new. So when I say new news, that's kind of repetitive. It should just be news, I guess. And probably going to change that because it's not necessarily necessary to put the word new there. It simply means something's changed. When something's changed, that's news. And the imaginations of the traders, of the market, so to speak. Let's go through these one at a time. Prior moves cause current moves. Now, what you need to understand that buyers and sellers are what moves the market. The buyers and sellers in the foreign exchange market are traders like you and I, banks, hedge funds. It's also importers and exporters of real goods and services. It's also what's called derivatives traders, option markets. They have something called an exchange, like kind of. Well, let's stick with options because most of us may have a feel for what that is. But basically, the buyers and sellers are traders. They're hedge funds. They're banks. They're importers and exporters. And then there's something called the central bankers, which is each country. You guys have the Bank of England. We have the Federal Reserve here in the U.S. Europe has the European Central Bank. Australia has the Reserve Bank of Australia. They are in charge of the money in their country, so they're in charge of the currency. A currency definition is a country's money. That's simple. And being in charge of it, they keep what's called reserves. They keep certain amounts of their money in currencies other than their home currency, so that they can make payments, and in case their currency gets in trouble, they have other currencies to sell to buy their own currency. That's called intervention. So all of these are buyers and sellers, and these are what move the market. So now what you want to understand is that when an exchange rate changes, meaning if the pound-dollar currency pair goes from $1.60 to $1.70, it brings out new and different buyers and sellers at that new exchange rate. And in real life, every small movement of the exchange rate may drum up some interest from a buyer or a seller, or both. So the market keeps moving and the prices keep changing because as the exchange rates move, it brings out interest from other traders, central banks, importers, exporters, a whole slew of different players in the market. So a big part of the movement is simply because it moves to different levels, new interest is brought out. And that's what a big part of the movement is from. Another part of it is the news. And by news, we mean something different about a country. If something different comes out when you look at the news, Bloomberg or Reuters or television news, Sky News, whatever it is, when something different comes out about a country, especially economic stuff, it can impact the value of that country's money, its currency, and hence all of the exchange rates linked to that country. So, for example, in the case of the UK, you have the pound. So you have the pound-dollar pair. So if news came out really negative for the pound, it would cause the pound to go down versus the dollar. It would cause the pound to go down versus the euro, versus the Swiss, versus the Aussie, versus New Zealand, versus yen. So news about a country's currency, about a country, especially economic news, can have an impact on the value of that country's currency, and hence all of the exchange rates of that country's currency versus other countries' currencies, they all change because of that news. And when they go to those new levels, it brings out a new bunch of buyers and sellers, and hence there may be a second reaction, if you will, or a second movement, which was in effect caused by the first movement. So the news can cause a movement, and then the fact that the price goes to a new place, it can cause another movement. And now it's gone to a new place, and it can cause yet another movement. In my 30 years of experience doing this every day, I think that's pretty much sums up what causes the currencies to move. The only other thing that really is important is the opinions of what a currency may be worth in the future. And that has a direct impact on its current value. And as opinions change, the currency's value, its exchange rates change. So for example, if the UK came out and printed $75 billion last week, and when that was announced, it was a little bit of a surprise to the market. The market was thinking they may print something or they may not. When they said they're printing, and they're printing a pretty good amount, the market took that negative, and the pound went to a new place. The pound went down in value. However, it went down in value against all of the currencies temporarily. Now, against the weaker ones, for example, the U.S. dollar has been in a weakening phase all of last week and the week before. Because of the weakness in the U.S. dollar, the pound-dollar rate, although it went down because of this news about the printing money, it went back up because not because the pound got stronger necessarily, but because the U.S. dollar was doing poorly. So we need to get used to the idea that there's two currencies in the pair, and either one of them, news about either one of them, or directional price action related to either one of them can cause the exchange rate of that pair to move around. And traders get these ideas in their head, and they really beat up on certain currencies. We saw that with the euro a couple of years ago when Greece first started having problems balancing their government's books. The euro really took a tremendous beating, really took it on the chin. And you know, it's just, okay, let me see. People are saying they're losing sound. That's probably your internet. But let me see. If a lot of people are saying that there's a problem, if only a couple, I'm not going to worry about it. It's probably your internet. There's not much I can do. So I'm going to, for the moment, I'm going to escape here, and I'm going to stop sharing for just a moment, guys. I'm sorry about this. And okay, so here's what you got here. We got 1, 2. Yeah, you see, you got three or four people having a problem with sound, and we've got 97 people in the room. So what it is it's your internet on your end. It's not on my end. So I'm not going to stop for any more sound things here because it's happening. It's really on the internet. There's not much I can do about that. Let me put the picture back up. And all right, running into a little bit of problems here. It's kind of like the market, you know. Everything was fine and changed something, and now we've got problems. And I honestly don't know what's happening here. It's just spinning around here for a moment. It's unfortunate. Okay, so we got a little bit of a problem now because for some reason my computer now froze up with this. I can see on your end. Oh, wait a minute now. Yeah. You are no longer viewing the presenter's shared internet. That's what it's saying. Yeah, I see that. Yeah. Okay. Gee, I wish I didn't. Oh, wait a minute. Looks like we got some progress here. There we go. Decided to start working again out of nowhere. Yeah, that's good. Let's get rid of that. All right. So I'm not going to stop anymore for if you put comments about the sound, because it's probably your internet. Okay. So as I said, these are the three things. So now, how do bank traders keep track of the market? We look at the exchange rate history, the charts. We pay attention to the news, and we read what other traders are saying. So we want to know how strong the opinions are, how much exaggeration is going on in the market. What currencies are traders considered hot, which ones they're considering cold, and how the news is relating to that. These two things are very important for a trader, a bank trader. And we also look at the exchange rate charts, the history of it, but really what's cooking with the news, what's cooking with what other traders are saying, and a whole slew of other things are just as important as looking at the charts. Now, when we look at the chart, we look at it in terms of not just the formation we see on the chart, but what's causing it, the news, the opinions, all of that, because that all comes into play. Now, how do retail traders keep track of the market? Well, here's how they do it. They look at the charts, they ignore the news, they ignore what other traders are saying, they just focus on the charts. So would it be fair to say that retail traders are trading with one eye closed? In my opinion, at least one eye closed, more like 1.5 eyes closed, because all they're looking at is an historical chart of the linear price movement of the currency pair without relating it really to anything or having any knowledge of what they're doing beyond looking at a chart and then learning some interpretations of the historical chart, and that is completely their basis for trading. What else are retail traders not doing? Well, simply put, most retail traders have no clue what they are doing. And in my opinion, they're just throwing their money away. What do retail traders need to know besides charts, news, and opinions of the market? Well, there's a long list of things to know before placing a trade. Now, here's the issue. Most retail traders don't have the drive to learn to trade properly. They are pursuing a fantasy, and as such, there is no real world work being done before the trade, during the trade, or after the trade. They have this impression that foreign exchange trading is easy. There's nothing to it, therefore there's no work to be done before, during, or after the trade. Now, what is it the bank traders are doing before, during, and after the trade? Well, before the trade, we're studying the market and deciding to make a trade. During the trade, we're asking ourselves, if I didn't have this trade on, would I put it on now? And after the trade, we're going to learn and grow. Whether we win or whether we lose, we're going to learn because we're going to study what we did and figure out what we did well and what we did wrong. And we're going to do this over and 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 over again. And why do we do that? Because that's how we make a living. This is how we feed our families. So we don't take it lightly. We realize that this is a profession and this is a very difficult thing to do. And we sure as hell better study the market before we do trades. And when we have a trade on, we better really take a look how that trade is really doing. And after the trade, we need to learn and grow each and every time we do a trade to get really good at this. See, the retail trader, typical retail trader, trades without knowledge, which means they can't possibly learn from their mistakes because they're not thinking about what they're doing in the first place beyond looking at a linear chart and some indicators. So I don't think there's any way they can get better at what they're doing. And also, it's very unusual for a retail trader to try to learn from his prior trades. In trading, if you're going to get one thing out of today's lesson, it's the psychological part of trading, which is the timing and how important or critical it is. So, for example, when you buy, the price or the exchange rate needs to not go down so much that you get nervous and you close your trade and you lose money before the price goes up and makes you money. And this is the challenge. When you jump into a trade with a very limited analysis, just some historical charts or magic indicator, you really don't have necessarily a really good entry point. And most retail traders are trying to work with a really tight stop loss because they don't know what they're doing, so they don't want to risk much in terms of what's called points, and we'll talk about what they are later. So they tend to put trades on at not the best points from the point of view they didn't really think that hard about where they got in the trade, and then they don't give the trade very much room to work out, and so their margin of error is very small, and the fact that they don't really do a good job of analyzing their trade before they get in it means they're kind of sloppy getting in, and they're not giving it much room to work out. So most of the time, their trades are going to get stopped out before the price does what they were expecting it to do. So it's very important to understand, if you lose on a trade, you lose the amount of money you lost on a trade, plus if that trade soon after turned around and would have achieved the profit you were looking for, then in effect, in real money, you had a small loss, but in the bigger picture of it, you didn't make the profit, so you had a much bigger loss than you think. Now, you should be a chicken. You should be a chicken and not lose too much money on any one trade. At the same time, you should be a courageous chicken and be willing to lose a reasonable amount of money on your trade. Unless you do this, your trade does not have a real chance to make you money. So before we even start trading, we need to have a method figured out of what a reasonable amount of money to risk on a trade is to give that trade a fair chance to be successful. It's not a matter of a reasonable amount of money saying, well, 50 pounds is a reasonable amount of money to me. Not in that respect, but in respect of, am I giving that trade enough room to be successful, or am I just kind of playing semi-lottery here? Because if you start playing semi-lottery, which means you're just kind of hoping that you're going to get it right almost immediately because you want to put a really tight stop, then the chances in the long run of not getting stopped out most of the time is very low. So it's not a recipe for success to just put tight stops on all your trades. A recipe for success is to risk a reasonable amount of money to make a reasonable amount of money, and all based upon a knowledge, a complete knowledge, as much as is practical and reasonable, that you understand what's truly going on in the market. Now, how long do you stay in a trade? You can, for example, buy in anticipation of selling at a higher price minutes later, or hours later, or days later, or weeks later, or even months later. Now, which one? Which one depends on you? You need some kind of a plan of action of what it is you're doing. Now, a trading plan, you simply say, when am I going to trade, what am I going to trade, and how am I going to trade? And this needs to be solid. This needs to make sense. And this is your blueprint for success in trading. You need to write out your trading plan. Now, as you start to write it out, you're going to realize that you don't have a trading plan. You don't have a complete trading plan. You have little bits. Now, I'll give you a hint. You want to make money is not a trading plan, because for a lot of traders, that's what it is. You say to them, what's your trading plan? And they smirk and say, I want to make money. You know, that's not a trading plan. That's basically a plan to fail. You know, that's not enough. You actually need something in writing that makes a lot of sense, something you can and will do, and you need something that's solid, something that's based on something real, you know, and something also that you can believe in, something you can believe in to the point that you can put your money on it, and you're comfortable with the fact that it's not going to win all the time, and you can take your losses on the chin and keep going. And again, this is not an easy thing to do. Now, what do you need to trade Forex? What do you need? You need a computer. You need the internet. You need some money. Over in the UK, you need a spread betting platform. Here in the States, you would need what's called a broker platform. Essentially the exact same thing. The same. Everything's exactly the same pretty much. The spread betting platform's kind of cool because if you make money, you don't have to pay taxes. But let's face it, guys, we're 14 floors from making money. We got a long way to go before we're going to make any money. So worrying about making money that's later on, you know. So spread betting platform has its benefits. It also has some minor drawbacks and all. You know, like anything, whether you're trading with a broker here in the States or you're trading with a spread betting platform, you know, you still got to pay for the service, and it's actually very cheap. The charges are very low, really. It's a very good deal, actually, for the retail client. For somebody who's more of an institutional or CTA, they're doing larger transactions, it can get quite expensive. But for a retail client, for most of us, our trades are going to cost us like £2 is normal to do a trade. I kind of recommend you do one trade a day, maybe two to most. So your cost of doing your business is £2 or £4 a day. Even on a monthly basis, that's only 40 to 100 pounds a month to run a full business, which is pretty cheap. The other thing you need is know-how. You actually need to know how to do it. And not only see, know-how is confusing because know-how can mean how to do it. Knowing how to do it is not going to make you money. Knowing how to do it profitably is going to make you money. And they're two different things. What I'm going to try to teach you in these 6 sessions is how to do it. Not how to make money from it, but how it actually works, so that you've taken the first step to actually being successful because you have some clue of what you're doing. Now, the spread betting platform, this is where you're going to place your trades. You can go get a free demo. Even IG Index now has a free demo. So and that's a big firm over in the UK, and there's a whole bunch of them. You can go on Google and say UK spread betting platforms, and you can compare them, and you can read reviews, and get plenty of information. But this is where you're going to place your trades, and this is something you're going to need to trade. You're going to decide what kind of bets you're going to make if we're going to call them bets. I use the term bets, and bets implies gambling. I don't consider my Forex trading to be gambling. In fact, I consider it to be very far from gambling. I consider it a revenue source. I consider it that if I trade the way I know how to trade, and I'm disciplined, I can make money from it. So I don't consider it a leisurely betting thing. I consider it to be a business that I make money from. So when I use the term betting, I'm using it kind of loosely. Now you decide what bets you're going to make, and you're going to decide how much you're going to bet. And by deciding on your bet and then how much you're going to bet, the amount you're risking is exactly determined by, you guessed it, that would be you. And you're also going to decide when you should close out your bets, when you should close your trades. So it's going to turn out in the end that your decisions is going to 100% determine your results. And we need to, from the beginning, look at yourself in the mirror and say, this is all about you. It's got nothing to do with anybody else but you. You need to own up before you start to the fact that if this is going to work or not work, it's going to be 100% based upon your performance and how you do. Okay. Looks like I got another little slight problem here. Okay. Now, how I trade. Let me give you a brief description of how I trade. This is my personal trading methodology. That word is too long for me. This is the way I trade. And this is how I teach my students to trade. We start with a trade signal. We get a Jimmy's band signal, a European breakout signal, a 1 minute 60 SMA signal, a news trade signal. We start with a trade signal. Now that's usually where the retail trader stops. He got a signal, he's got some kind of chart and some kind of arrows flashing, and he's ready to do his trade, and that's all he does. That's where we start. That's where most retail traders end. For us, the next stop is we don't blindly take the signal. We think about it first. Well, what are we going to be thinking about? We're going to be looking at other things and saying, are these things agreeing with the trade signal we see? Without going into any details, we look at what the DAX is doing during your London time period. In the US, we look what the Dow is doing, and we relate that. We look at which currency pair we're getting a trade signal in, and we see what the currencies that make up that currency pair we're trading on are doing. The exchange rates of those same currencies are doing in other exchange rate pairs. So, for example, if we're thinking of buying the pound dollar, we're going to take a look and see how euro dollar is doing, how Aussie dollar is doing, how New Zealand dollar is doing, how dollar Swiss is doing. We want to have a feel in general for how the dollar is doing, because that's part of our currency pair. And then if we're buying the pound dollar pair, we want to look at pound dollar, pound euro, pound Aussie, pound New Zealand. We want to have a feel for, in general, how each of the two currencies that make up the exchange rate of the pair we're thinking about trading is doing individually, to get a good feel for whether or not this trade makes sense to do or not. So we're going to look at what else is agreeing. More importantly, we're going to look at what's disagreeing. What is telling us that maybe we shouldn't be doing this trade? Maybe we shouldn't be doing this trade right now. So the question is, maybe I should wait, or should I wait, or should I jump right in? And that becomes a function of way beyond having a trade signal, but also thinking it over and weighing the pros and cons and coming to a conclusion of whether I should jump in, whether I should wait, or perhaps whether I should do nothing. But in the end, what we need to say, well, when are we going to do something, under what conditions, and why? this is what I do. This is what I teach my traders to do. To me, this is the real way that trading profitably happens. I don't think it's enough just to look at charts and just to base it on the charts themselves, which is a linear look at what already happened. You can have all the magic indicators you want, but you're still just speeding up and slowing down history, and then going back into history and trying to predict the future based on what already happened, which is very, very suspect. So this makes a lot more sense to me, this kind of an approach, and this is what I teach my students to do. Now the first thing, and this came up just yesterday in Twitter, and Twitter is where I have my live trading group. If you are going to start with a system signal, so we start off, we say, okay, we want to see a system signal. Now, you want to make sure that you get the signal right. So yesterday, first of all, he said, okay, I think you should, do this trade based on this system. And it turned out there wasn't really a system signal there. So it's hard to get the whole trade right if you don't get your start of your trade, your signal correct. If you don't, in fact, have a signal based upon the system, then whatever you do, if you call something a signal and it's not, you're starting off on the wrong foot right from the beginning. So it's impossible to get it right, really. And so basically, we use the expression GIGO, which means garbage in, garbage out. Garbage in, garbage out. So unless you have the right premise, you can't come to the right conclusions. And it's very important. It may sound very rudimentary to you that you have to have you have to make sure the signal's correct, but a lot of people don't do that. They kind of skip that part, and they're already, I see it on Twitter. It happens quite a bit where people say there's signals when there's not even a signal. So if you're going to trade, whatever signals you're going to use to trade, make sure you understand and can properly calculate whether or not you have a signal in the first place, because that's only the first step in a 7-step process, the way I see it. Now, a lot of traders, especially retail traders, they're very nice about it, but they basically tell me, well, Jimmy, I don't want to learn all this. I don't want to do all this. I just want something simple because I don't want to make a lot of money. I just want to make a little money. And I can understand that, and I really can. I feel your pain that you don't want to have to do so much. But frankly, when you think about it, to get a trade right, you have to get the trade right. If you're betting £1 a point and you get a trade right, you made 30 pounds for 30 points. If you get it right for 30 points and you're betting £1 a point, you make 30 pounds. That's how it works. We'll get to the spread betting platform. That's the very last session we're going to do, is talk about how to do the trades, because I really think first you need to learn how to trade before you start doing trades. But I mean, if you bet £1 a point and it's 30 points, you make 30 pounds, 30 times £1. If you're betting 1,000 a point and you make 30 points, you make 30,000 pounds. Whether you make 30,000 pounds or you make 30 pounds, it's still a case of you have to get the trade right. So the process of getting it right is no different when you bet a little than when you bet a lot. You still got to get the direction correct, which means you have to go through the trouble of doing it right. So it's not a case of I just want to make small bets occasionally, so I don't want to know too much. You need to know what you're doing to make money at any level. Now you want to ask yourself, let's say you do a trade, you ask yourself, why did I do that trade? Well, the wrong answers are because I was bored. But believe it or not, a lot of traders sitting there, they're watching it, and they don't really know what to do, but they want to do something, so they jump in. Or they get a signal and they don't take it any further, and that signal was really not that good. There was lots of reasons based upon the methodology. In other words, when I teach my students is you get a trading signal, and then here's what you're going to look at. Number 1, stocks. Number 2, correlated pairs. Number 3, room to go, blah, blah, blah. They're going to go through an exact list. And actually in that list of room to go, we'll talk about that at some point. over the next 5 or 6 sessions, but the room to go is actually the first thing we look at. Then we look at what are stocks doing, what are correlated pairs doing. We go through a process of exact things we look at. So our methodology is very exact and very systematic, but what we don't do is stop at right at the beginning. We got a signal, so we're all done. We take it to a few more practical levels and interrogate the signal. So a wrong answer would be, I got a signal. And definitely a wrong answer is, I don't know. I just kind of took a shot. Because that don't make you a trader. That makes you a bettor. And bettors lose consistently. Gamblers. The right answer is, I got a signal. I saw there was good confirmations from several angles saying this is going to be a good signal. And I'm a trader. This is what I do. I trade for a living, and therefore I have to make money from trading. So when I get a good signal, meaning it's a signal that has good confirmations, I have to take that trade because I have to pay myself. I have to make money. So when I see something good, I have to do it. That would be the right answer. Now, to finish up, I've got another 25 minutes, and I really wanted to go through my 45 ways to avoid losing money. Let's take a look at this together. This is an article I wrote back in 2005, actually, and it's going to put it up on a screen here, so I'm going to escape this. I'm going to put this down, and I'm going to go to Firefox. Firefox has quietly taken over, hasn't it, from Internet Explorer. And I'm just going to go right here. I just popped it up from Forex Factory. Now, at the end of the seminar, actually I'll do it now. I'll take the article, edit, copy, and I'm going to, no, I don't want to stop sharing now. I'll do it later. I'll give you the exact thread. This comes from Forex Factory, and it's actually the guy listed 3 pages of articles. Actually, he listed like 150 articles, and he put this number 1. This is the very first one. And at the bottom here, you can see quite a few good comments about it. Of all the Forex list of points articles, I think this is probably the best one by miles. This list is a real thinker for me. I've seen lists before, but many of the items here were real whacks on the side of the head. Very good points given. I hang this on my wall, blah, blah, blah. This is probably the best article I've read on the market. Thanks for posting, et cetera, et cetera. So this is actually, this is something I wrote. It's up here from 5.5 years ago. But I actually wrote this about 7 years ago, something like that. And it hasn't really changed. And I think it would be very worthwhile if we went through it. And then I'll give you the thread for it, where you can go and you can read it yourself and have it for yourself. I know some of you have already read it, but what I have not done is explain it to you as I went along. And I think you can click right here, and there'll be thousands of Forex articles. As a matter of fact, let's do it for the fun of it. I think there's a lot of Forex articles, like 1,000 of them. Don't know where they all are. Sorry. The last time I looked, there was like 1,000 different articles. But anyway, let's go through the list here. Knowledge deficiency, okay? It was my observation back in 2004. And I'm not going to keep saying 2004, 2005. I'll just say my observation now or whatever. But most Forex traders, they don't take the time to learn what makes the market move, what makes currency rates move, which is primarily fundamental. And fundamental is defined as anything that's not derived from a chart. Something like news, they completely don't even look at it, just leave it out totally. And, the point I was making here is, you really need to know what you're doing if you expect to succeed at this. So the number one reason I think retail Forex traders fail is because they don't know what they're doing. They jump right in without getting their education first. It would be the same with a doctor or a lawyer. Could you imagine a lawyer going on a murder case and, read a couple articles about law? How do you think he'd do in court? It's the same with trading. When you have no clue what you're doing, you go in there, you start betting. But that comes from this internet charged um, fallacy that trading's easy and forex trading's simple and there's nothing to it, because nothing could be further from the truth. Now, I see the number 2 reason why the retail traders fail is over trading. Too often they use very tight stops and little tiny profit margins, and so they do a lot of trades, and for very few pips profit or loss, points profit or loss, and each time they do a trade, they have to pay the spread. That's the difference. There's 2 prices. There's the price you buy at, the price you sell at, and they're slightly different, and that slight difference is called the spread. Every time you do a trade, you have to pay that spread. It's kind of like a commission. If you look at it as a commission, like when you buy a house, you pay a commission. Well, when you buy a currency pair, you pay a commission. And if you're doing many transactions, you're incurring many commissions. And plus, how quality can your trades be when you're doing trade after trade after trade? You don't have that scrutinized quality in your trades. So you have so many things working against you when you're over trading. Another thing is leverage. Leverage is a 2-way street. If you get it right, you make a lot, but if you get it wrong, you lose a lot. And most retail traders tend to bet too much at once because they're trying to make too much money from their money. We must be very realistic and remember right now that you get 0% interest in the bank. So making 20 or 30% on your money is head over heels terrific. Trying to make thousands of percent is a recipe for disaster. This one here, relying on others, real traders play a lone hand. So once you learn how to trade, you should be trading on your own. You should become comfortable with what works for you, what doesn't work for you, and not relying on anybody, because you have a certain personality and you have a certain comfort zone, and you need to find that comfort zone and find your niche to make money in these markets, because there truly is room for everybody. Now, stop losses, this is something I see on my Twitter page with my live trading with my students. Their stop losses are so tight that they're always getting knocked out of their trades before they give the trade a fair chance to develop. And that's more like a matter of, really kind of surrendering that you don't really know what you're doing when you're not willing to risk a reasonable amount. And by reasonable amount, I'm talking about if you're trying to make 50 points, you risk 50 points, that kind of an amount. Nothing crazy, just simply something that's realistic. Now, the demo accounts, you have to be very careful with these, because sometimes the demo accounts move slower than the real accounts. In a demo account, there's no slippage ever, so it's not really realistic of how it would be trading in the real world. So a lot of the magic indicators that people use to trade, like I'm using the example of short-term moving average crossovers, if the account goes slow enough and the price action moves slow enough, it appears that these kind of systems are tradable, until you trade in real time and the market moves a lot faster, and you find that by the time you're seeing the signal, it's consistently too late. And demo accounts in general, I mean, you can't pay your mortgage with demo money. They're okay for learning the platform. My son, as I told you, my son started his training with me this week. He's going to start trading next Monday, and he's not going to he's going right to a real account from the beginning. They're going to skip the demo completely, and because I really don't think you need it. To play it safe, if you're he's really good with computers, because he's 23 years old and he's a computer addict. He's had his first computer when he was 7 years old, and he's gotten one every 2 years since. So he's very good with computers. So, he's not going to make the mistakes of some of, people like myself who are approaching 60 who really are not computer savvy. You need a demo. because you're fumble fingers and you're going to make all kinds of dumb mistakes at first, and better you make them for free than for real. So that's the difference. But demos in general should not be used to simulate real trading results, because the fact is, when you trade for real, you trade differently than you do in a demo. And plus the demo gives you some advantages that are not going to be there later on, so you can develop some really bad habits from a demo. There's good hours to trade and there's bad hours to trade. The good hours to trade is the London morning, the US morning, and that's about it. Those are the good hours. During the off hours, the market's very thin, and any little bit of business can push it around, and sometimes even some of your bigger traders, cagey traders, can push it around. It's really not the time to be trading. The best hour is the US morning, the European morning. That's when the real good trading takes place. Another common problem with the retail trader is they get a view on a currency. I like the dollar, I like the euro, and they don't make enough of an effort to study up on what currency they're going to pair it with. We can't trade one currency. We have to trade a currency pair, which means, in effect, the exchange rate, what you're betting on, whether the exchange rate goes up or down, is a function of two things. It's a function of the currency you buy, which is, if you buy the currency pair, you're buying the first currency in the pair, and the pair is being valued. The exchange rate is based upon whatever the first currency is, and it's denominated or quantified in terms of the second. But in reality, what you're really doing, in effect, is you're buying one currency and you're selling the other. So if one is strong and one is weak, that's what you're looking for. You're looking to buy a strong one and sell a weak one against it, and you get maximum movement in your favor in the exchange rate. But when you don't pay any attention to the second currency in a pair, for example, it's very possible on a given day that the pound-dollar pair can go up and the pound-euro pair can go down. And I mean a lot. Like pound-dollar could go up 100 points, which is a lot, and the pound-euro could go down 100 points. In both cases, you bought the pound. In one case, you made 100 points. In one case, you lost 100 points. And the difference is you did not, in one case, you chose the correct pair, correct currency to pair the pound with, your bullish view, or you thought the pound was going to go up. Well, if you were right that the dollar was weak, bang, you made 100 points. But if you indiscriminately just chose the euro, which happened to be even stronger than the pound, it's possible that you could have lost 100 points. So you need to think about both currencies in the pair. Now, your trading plan, I think this is actually, it's funny, I haven't read this probably in 5 years, but it says, make money is not a trading plan. That's exactly what I wrote on the slide we looked at earlier. Your trading plan is your blueprint for trading success. You need to spell out what your edge is. Like, how is it you're going to beat the market? For my students who take my more advanced classes, our edge is that we have systems. We have very specific tools to interrogate those systems signals to make sure that they're good ones. We have good money management skills. We understand the fundamentals. We know about when the news is coming out. We know how the news should probably react, and we can actually even try to get in there and make some money from that. So we know what we're doing. That's our edge. That's the banker's edge. If you don't have an edge and you don't have a plan, it's very likely you're going to wind up as a statistic, which means the 95% losers club. I give you the hard love, guys. That's just the way I run. Now, trading against the prevailing trend is another thing that I'm not big a fan of. And I know that from looking at Twitter, most of the traders on Twitter, they're into trying to, they want to buy it, but they want to buy it when it's going down, and they want to sell it, but they want to sell it when it's going up. So they're always looking for that best price. It's not really the way I like to trade. my preferred way of trading, my preferred way of teaching, all of the system signals of the main systems we use, such as Jimmy's bands, European breakout, are based upon new highs and new lows for a significant period of time. That's what we do. So when you're trying to always be guessing where turns are going to happen and all, you're really putting yourself, I think, at a huge disadvantage. Exiting trades poorly simply means you put a trade on, it's not working, so you get pissed off and you wait till it's absolutely terrible, and then you get out, and you feel sorry for yourself. And the market always hurts me, and the brokers run my trades, and they're always stopping me out at the low because they go through millions of dollars of orders to stop out my 1 pound position. This kind of like feeling sorry for yourself, pitying yourself with your trading is typical of traders that exit trades poorly. A professional trader puts on a trade. If the trade's not working, he's like, okay, this ain't working. I've got my stop loss in. If it hits that, okay, I'm dead. There's not much I can do. But if it starts to come back towards where I entered, I can very coyly get out and just lose a little bit. That's exiting well. Exiting poorly is more or less becoming emotional and pissed off and just kind of, torture yourself by losing as much as possible. It's just this kind of amateur behavior is that of a bettor and not a professional trader. Now, trading too short term, this is a huge one. If your profit target is less than 20 points, you shouldn't do the trade because the spread is it's just too much against you. Now, this was written 7 years ago, and at that time, the spread in euro-dollar was 5 points. The spread in euro-dollar today is 2 points, even 1 point. So if you were going to be what's called a scalper, then going for, say, even 15 points is still risky because, you see, the problem is when you trade too short term, not only are you paying the spread on every trade and doing a lot of trades, but also the way the algorithms work with the spread betting platforms, your stop losses, if you're the only person at that particular price, is give or take 1 or 2 points, which can make a difference when you're only looking for 15 or 20 to begin with. You're going to get stopped out, and if you have your profit target there, and you're the only profit target at that level, only price at that price, wanting to do a deal, they're not going to give you your trade unless they have to, because they may not make any money on it. So these things going against you, you really want to stay away from that trading short term. Now, having said that, if you put the trade on and it's not working out, you want to get out at a small loss, or you put the trade on, you had good money on it, but now it's back almost to break even, you just got a little bit of profit, you want to get out, that's fine. You can do it then. But you shouldn't go into trades thinking, I'm going to make 5 or 10 quick points, because that just don't work. The spread's a big part of it, and the broker execution thing is another part of it. So try not to do that. Picking tops and bottoms, bargain hunting at the supermarket does pretty good. You clip your coupons, you can save a few bucks. But if you want to make money trading, try and stick with trading in the direction the price is going makes a lot more sense. And we refine that quite a bit in our different programs, where we in different time periods look at tops and bottoms, but in shorter, fine-tuned time periods, we're actually moving in the opposite direction. So we're trying to, instead of trying to pick a bottom, we may see it go down to what we think is low levels on one time period, let's say an hour, but then we'll go to a 5-minute chart, and when that's going up, we'll buy it. So we're always trying to trade in the direction things actually going, because with all other things being equal, you want to try to be trading in the direction it's going. Because it's more likely to keep going than it is to turn around and go the other way. Now, being too smart is definitely a drawback. The most successful traders I know, they're high school graduates. They never did college. They never did graduate school. They keep it simple. They don't look beyond the obvious. and their results are excellent. And I don't mean simple from the point of view of just looking at a chart, but they have a game plan. They look at a few things, a few important things. They stick with that, and they don't try to outthink it and try to go way beyond. You know, most of us tend to just way outthink it. Like, well, if this happens, then this could happen, and we turn it into a novel. We turn it into a good romance novel instead of what it is, which is simply traders and importers and exporters and central banks and other entities just trying to do business in Forex, but most of it just being very random, of a very random nature. It's not this big, full-blown espionage story we try to turn it into. Most people don't like trading around the news. I think there's wonderful opportunities there. I think just the other day on the Twitter I saw Claire said, you know what, this news wasn't exactly good enough for Jimmy's system, but when you add it all up, it looks great. I'm going to take the trade anyway, and 100 points later, her favor, you know. So trading around the news is absolutely nothing wrong with it. Your brokers, spread bettors tell you not to do it because it doesn't help them, and it's hard for them to make money when you trade around the news. So if it's hard for them to make money, it actually, in effect, is almost easy for you to make money. That's why they don't want you to do it, because not that they don't want to see you make money, but they don't want to lose money themselves. Now, most retail traders, they ignore the technical condition, and this is a hard one. This is one, if I was at the seminar, I'd be looking out for the Botox. That's where everybody's forehead starts squinching up and their eyes start twitching and they're almost closed. Like, what are you saying? What do you mean? And this is technical condition. So basically, when something has gone up quite a bit, it's in a very weak technical condition because the buyers become exhausted. And when something's gone down quite a bit, it becomes in a very technical, strong position because the sellers can become exhausted. And getting a feel for the technical condition of the market is an art. It's part of trading that can't be quantified, or it can't be seen on a chart or any page on the internet, but it's a skill that you begin to feel, which I teach my traders how to be looking out for that, because it's very important. All right, we're almost at time. We'll do a few more, and then I'll leave you to go through the rest of the list yourself. Emotional trading is a problem. You know, you got to remember, if you just jump into a trade, you know, you get a thought in your mind, you jump into a trade, you know, and you don't have any pre-plan going on, then you're not thinking. You know, you're reacting. Two totally different things. It's a very poor basis for doing a trade. You know, you think about it. Do you ever say anything intelligent when you're all upset? You know, in my case, you know, the things I get upset about, if I blow my top, so to speak, I get myself in a lot more hot water based upon what I said than anything that the real problem in the first place that got me upset. And I think it's the same in trading. We need to have a plan. Like what I teach my traders to do on Twitter is to say, okay, we've got a signal coming up pretty soon. You know, we're getting a Jimmy's Van buy signal in Eurodollar coming up pretty soon. Not yet, but it's coming up. You know, what are we thinking here? Are we going to be taking it, not taking it? What other information can we look at right now so that we can precondition or pre-plan our trade so that if the trade does happen, and assuming we're still keeping an eye on the other things we like to look at, we know right away whether this is going to be looking good or looking bad, and whether we should take it or not. And it's this kind of pre-planning and all is absolutely necessary. Totally dissed by the retail trader. They're just looking for the signal, and then the afterthought. You know, get a signal and take the trade, and 10 minutes later, you know, maybe it don't look so good anymore. Well, maybe it doesn't look so good. It may look okay on the trade itself. You may actually have a profit, but the other things may all start looking bad. Now, what we can do is jump out of that and take a little profit. Whereas if you're not looking at those other things and you're not really seriously trading, so to speak, well, you're going to sit with that thing and until the price goes totally against you and you lose. You're not going to know that your trade lost its power. All right, we're going to just do one more, and then we'll call it a ball game here. Lack of confidence. Lack of confidence. Confidence only comes from one thing, and that's making money trading. If you lose money early in your trading career, it's very difficult. It's very difficult to get that confidence. The trick is don't go off half-cocked. Learn the business before you trade. Be a good trader before you actually trade. Don't jump in not knowing anything and then have a bunch of baggage, mental baggage, your mind telling you, don't do that, you idiot, you always lose. You don't want to have to deal with all that, And just, a lot of us never get to the point of doing a real trade because we lack the confidence, because we never done a real trade. We never made any real money. All that demo trading and all in the back of our mind was saying, yeah, but I never would have done that really if I was trading real money. So that's why I don't like the demo. All right, let's do a couple more to heck with it, and then I'll definitely call it a ball game. I still got 2 minutes. Lack of courage to take a loss. This is something that it's the other extreme of putting in a really tight stop. It's where you get the kind of person who got the trade wrong, he's losing money, and he's like, I don't care. I got balls. I'm not going to close my trade. What you don't have is brains, because obviously the trade ain't working. But a lot of people think that they're being brave by just staying with a losing trade and losing a large amount of their account. See, what I think is you're showing a lack of courage that you can make the money back by not just taking a small loss and saying, okay, I didn't get it right today, but I lost 1% of my account. I still got 99% of it. Tomorrow I'm going to make 1%. Then the day after that I'm going to make 1%. And for 3 days I'm going to make 1% on my account. Well, if I make 1% every 3 days on my account, at the end of the year, I'm going to make almost 100% on my account, which is damn good results. But what happens too many times is we just stay with a losing trade forever, literally, and we lose half our account on one trade and try to trade the next day. We got to get the other half back, and within a week, we've blown the whole account up. This is just piss poor trading. We need to learn right from the beginning in the trading plan that we have a daily stop loss limit, a daily trade limit, and we stick to the limits, and we never put ourselves in harm's way, so that you give yourself plenty of time to lose your money, so to speak, so that you can learn to trade before your money runs out. Last but not least, of the ones I'm going to cover today is not focusing on the trade at hand. What's happening here is, got retail trader puts on the trade, and he gets lost in the trade, starts to work a little bit, and now his attention is, he's already looking at the pamphlets for the second home he's going to buy on the Isle of Wight. Or if the trade is losing a little money and, right away he's afraid he's going to lose his house, they're going to take his house and his car away. And in reality, we're talking about, with a 50-point stop on a 1 pound trade, we're talking about 50 pounds more or 50 pounds less, which ain't going to change our life one bit. So we need to stay in the now. You put a trade on, focus on the trade. Watch the trade, watch for the different things you could be looking at. See, the reason that many people think it's boring to trade, to sit there and watch the market, is they're not looking at anything but a chart. So they're just looking at history being created. They're not looking at all the clear signs of what's going to create history. And that's why you want to learn. That's what you want to learn before you start trading. So, all right, I'm going to finish here. I am already at time, and I promised myself I'm not going to go over, because people have lives and people want to stay for the whole thing, which I can't blame them. So I don't want to go over. So I'm going to have to cut it here. If you have any questions about anything I covered, you want to send me an email, that's fine. Okay, let's see. Send me an email. Yeah, you send an email to Jimmy. I'll give you that address in a sec. Let's give you this address first of this article. Edit, copy, and I'm going to take away. I'm going to stop sharing and put it down here. Edit, copy. Okay, so there's the. What did I do with that? I sent it privately. That's not going to be much help. I got to send it to everybody. Let's see. Host, presenter, and panelist. Paste. Send. I don't see it going up there, though. Let's see. Is it up there? Yeah, there it is. Okay, so you got it right there. That's the address of the article. Or you could just go, if you type 45 ways Jimmy Young, it'll pop up right away as well. And that's that one article. There's a whole bunch of other articles there. Essential elements of a successful trader, how to read a chart and act effectively. There's a whole bunch of different articles I wrote during a period of 2006, 2008. Okay, so somebody's saying the library is closing at 8 p.m. here in the UK, so I have to leave. Can you please forward the lecture later? Yeah, I'll have Win send everybody a copy of this presentation. Next week, next Monday, we're going to be doing charts. I'm going to be going over charts on a more basic level, kind of like tonight, but all stuff about charts, just to give you a good solid foundation in charts, Forex charts, regular charts, trend lines, support and resistance, Fibonacci. You name it, I'm going to go over it in a general way, not my specific trading systems, but in general, so you have a general understanding of these different concepts, which is the next stepping stone. Now I notice we have 101 people in the room here. Hey Tony, how you doing, my friend? Good to see you, babe. I see we have 101 people in the room, and we only had room for 100, so I guess it's 100 plus me. So I'm going to talk to Win, and I may repeat this on Thursday for the people who weren't able to get in. So if somebody wants to come and hear this again, and you want to wait till 5 minutes after we start, then it's okay. But please don't take a space earlier than that if you've already heard it once, because you do have the recording. Because then the people who didn't get in tonight will not get in the second time. So I'm gonna repeat this on Thursday, because some people may not have been able to get in tonight, and I want to make sure they get in. All right, fair enough. I got to check it because it looks like it's allowing more than 100, so I got to see. So I got to check and talk to Win, but I may do this again on Thursday. And if I do, you'll all know. We'll make sure that Win gets an email out to everybody and lets them know and give you a second chance if you want to come. But again, wait for 5 minutes after the start so that we can make sure that the people who didn't get a chance this time. All right, that's about it. If you have any questions, I'm happy to take your emails. You can send them to jimmy@eurotrader.com. And I do want to mention, if you are interested in joining any of the programs, you should contact Win directly. Contact their, the customer service or whatever. I'll get the numbers for you soon. Their sales team, whatever, Brian and Ola and Curtis and Pascal and Natasha, that group. You wouldn't come to me for that. You would go to them. So other than that, I will speak to everybody definitely next Monday or possibly Thursday, and we'll keep you posted. Thanks for coming. Speak to you soon. Bye-bye.